Welcome to MindMirror Audiobook. Are you ready to uncover the secrets of intelligent investing? Whether you're a seasoned investor or just starting out, this channel offers the insights, strategies, and timeless wisdom you need to make smarter financial decisions. Hit subscribe and let's unlock the key to a prosperous future. Together. The Intelligent Investor. Revised edition is the definitive guide to value investing, authored by Benjamin Graham and narrated by Edward B. Graham. Benjamin Graham, widely regarded as one of the greatest minds in investment history, remains a beacon of reason and insight in the often unpredictable world of finance. His pioneering works, particularly Security Analysis and The Intelligent Investor, transformed investing from a speculative practice into a disciplined science. Graham's writings empower individual investors by providing them with a profound understanding of the emotional and analytical foundations crucial for financial success. Before Graham's revolutionary ideas, investing was often governed by superstition and guesswork, resembling the practices of medieval guilds. There was no structured methodology until Graham arrived. His work in security analysis redefined the investment landscape, establishing a research-based, disciplined approach to investing. This transformed investing from an art into a science, grounded in thorough research and cautious analysis. The Intelligent Investor, as a timeless masterpiece, is the first comprehensive guide specifically tailored for individual investors. Within its pages, Graham offers profound lessons on the emotional resilience and analytical precision required to navigate the unpredictable nature of the markets. His warnings about the inevitable rise and fall of bull markets, exemplified by the 1987 crash, highlight the enduring relevance of his principles. Graham's journey to mastery was paved with challenges, from his financial struggles during his youth to the devastating losses of the Great Crash from 1929 to 1932. Yet, these trials served as a crucible in which he sharpened his principles, ultimately solidifying them with wisdom, experience, and common sense. Central to his philosophy is the idea that stocks are not mere pieces of paper, but tangible ownership stakes in real businesses, with intrinsic value that far exceeds the mere fluctuations of share prices. Graham observed the market's cyclical nature, swinging from unwarranted optimism to unwarranted pessimism. This oscillation, he noted, created prime opportunities for savvy investors to buy low and sell high. The cornerstone of Graham's methodology is the concept of a margin of safety, which serves as a safeguard against overpayment and minimizes the risk of significant losses. By adhering to a disciplined mindset and avoiding the herd mentality often seen on Wall Street, investors can take charge of their financial future, insulating themselves from the whims of market sentiment. This revised edition of The Intelligent Investor juxtaposes Graham's timeless principles with modern-day financial markets, showcasing their continued applicability through insightful commentaries and contemporary examples. Readers, whether new to investing or seasoned professionals, will find clarity and empowerment in Graham's work. The book, like all classics, offers lasting guidance, enabling investors to navigate the complexities of the market with wisdom and prudence. With Graham as their guide, investors can embark on a path toward financial acumen and, ultimately, success. In the preface to the fourth edition, Warren E. Buffett reflects on his deep admiration for Graham's work, recalling the first time he encountered it as a young investor in 1950. Buffett's endorsement is a testament to the enduring legacy of Graham's teachings, which continue to influence his own investment strategy. According to Buffett, the Intelligent Investor remains the gold standard for successful investing. Central to this endorsement is Graham's assertion that successful investing is not about possessing extraordinary intelligence or insider information, but about cultivating a sound intellectual framework and mastering emotional discipline. Buffett emphasizes the critical importance of chapters 8 and 20, which offer invaluable advice for navigating market complexities. Drawing from his own experiences, Buffett affirms that adherence to Graham's behavioral and business principles leads to successful investment outcomes, even in the face of irrational market movements. He argues that while outstanding results depend on individual effort and skill, Following Graham's principles positions investors to capitalize on market inefficiencies and avoid being swept up in speculative mania. Buffett's personal connection to Graham goes beyond mentorship. He describes Graham as a life-changing influence, second only to his father. In a heartfelt tribute written after Graham's passing in 1976, Buffett reflects on the profound impact Graham had on his life and career. This sentiment resonates throughout The Intelligent Investor, offering readers a glimpse into the mentorship that shaped the philosophy of one of the greatest investors of all time. In essence, Buffett's preface not only reaffirms the timeless wisdom of Graham but also serves as a testament to the lasting legacy of a mentor whose insights continue to shape the investment philosophy of generations. The book, with its accessible and practical approach, is a vital resource for those seeking to navigate the world of investing with intelligence and discipline. Continuing from the principles laid out in The Intelligent Investor, our focus remains steadfast on imparting fundamental investment wisdom, rather than delving deeply into the technical analysis of securities. While occasional comparisons between individual securities may arise, our core mission is to equip readers with the essential principles that form the bedrock of sound investing. We aim to cultivate a mindset of prudence, grounded in a historical understanding of market patterns that span multiple decades. As the renowned philosopher George Santayana famously warned, "Those who do not remember the past are condemned to repeat it." This maxim is particularly pertinent on Wall Street, where cyclical errors often arise from a failure to learn from history. We believe that an informed investor, one who understands the historical performance of various asset classes, including bonds and stocks, across different economic conditions, is far better equipped to make prudent decisions. Our approach does not promise overnight wealth or endorse speculative trading strategies. Instead, we focus on historical examples that highlight the perils of relying on overly optimistic forecasts or yielding to market speculation. These lessons, accumulated over 5 decades of market experience, challenge the effectiveness of popular technical approaches and emphasize the enduring value of a principled, long-term investment strategy. Since its inception in 1949, The Intelligent Investor has undergone several revisions to reflect the changing dynamics of the market. The current edition incorporates crucial developments since the 1965 version, such as the volatility in bond interest rates, the significant market declines, the enduring pressures of inflation, and the evolving landscape of corporate finance. These shifts necessitate a more nuanced reassessment of investment strategies while upholding the timeless principles that Graham championed. This updated version acknowledges the challenges and opportunities presented by fluctuating interest rates, market volatility, and the emergence of new investment vehicles. At the heart of our philosophy is the idea that investors should adapt to prevailing market conditions with a balanced approach. We emphasize prudent risk management, informed decision-making, and the cultivation of a resilient mindset. Our analysis draws a distinction between defensive and enterprising investors, offering tailored guidance based on risk tolerance and investment objectives. While the allure of high-growth industries and speculative ventures is undeniable, we caution against over-reliance on such opportunities. Instead, we advocate for a disciplined, value-oriented approach that prioritizes long-term wealth preservation over short-term speculative gains. The principle of margin of safety, which Graham emphasized, remains a cornerstone of our investment philosophy. It asserts that investors should prioritize capital preservation, seeking to minimize the risk of permanent loss rather than chasing after speculative returns. A rational, measured approach to stock selection is central to this principle, with an emphasis on assessing the tangible value of assets and their long-term growth potential. Although speculative ventures may seem tempting, we urge readers to adhere to a conservative investment policy, grounded in fundamental analysis and a focus on enduring value. Ultimately, the aim of this book is to equip readers with the knowledge and mindset necessary to navigate the complexities of the investment landscape with confidence and resilience. By fostering a disciplined, informed approach to investment decision-making, we seek to empower readers to achieve their financial goals while minimizing unnecessary risks. This approach, grounded in the wisdom of the past, provides the foundation for making sound, long-term investment decisions. As Henry David Thoreau wisely observed, "If you have built castles in the air, your work need not be lost. That is where they should be. Now put the foundations under them." This quote beautifully captures the essence of our philosophy. It emphasizes the importance of grounding ambitious goals in solid, sustainable foundations. This mindset, central to our approach, distinguishes us from those who promise get-rich-quick schemes. Instead of focusing on market-beating strategies, we teach the essential principles that have guided successful investors for generations. The introduction to this revised edition reinforces 3 core lessons essential for long-term investment success: minimizing irreversible losses, maximizing sustainable gains, and controlling self-defeating behavior. These principles are especially crucial in navigating the unpredictable tides of the market. The aftermath of the 1990s tech boom and bust is a clear example, with many once promising tech stocks plummeting by 2002. This underscores the risks of speculative investing and highlights the importance of Graham's emphasis on loss avoidance. Despite the inevitability of market downturns, the intelligent investor provides strategies to manage these risks while maintaining composure. It stresses that the intelligent investor is not defined by academic brilliance, but by qualities such as patience, discipline, emotional control, and independent thinking. Historical examples, such as the collapse of long-term capital management and the speculative failures of Sir Isaac Newton, demonstrate that even the most intellectually gifted individuals can succumb to market irrationality when they disregard these timeless principles. By adhering to Graham's approach, investors are equipped not only to weather market storms but also to capitalize on the opportunities they present. In the end, true financial success lies in building a robust foundation of knowledge, discipline, and a long-term perspective, principles that remain as relevant today as they were when The Intelligent Investor was first published. Continuing from the discussion of disciplined investing principles, the narrative then pivots to a broader critique of recent financial catastrophes, from the dot-com crash to the corporate scandals of Enron and WorldCom. These events serve as stark reminders of the dangers of unchecked market enthusiasm and emphasize the critical importance of adhering to Graham's time-tested principles. Investors who ignored his warnings, driven by market euphoria and the promise of rapid, speculative gains, ultimately faced severe losses. These failures validate Graham's assertion that an investor's greatest adversary is often their own emotions and impulses. In the frenzy of irrational exuberance, investors lost sight of fundamental risk management, only to suffer the consequences once the inevitable market corrections occurred. In the wake of such disasters, the introduction contrasts past market irrationality with the current climate of pessimism. It argues that the recent market downturn, while disheartening, presents a more favorable environment for prudent investors. Unlike the optimism that fuels bubbles, falling stock prices often present opportunities to buy undervalued assets. The intelligent investor understands that rising stock prices amplify risk, while falling prices offer the chance to acquire quality assets at lower costs. This counterintuitive approach aligns with Graham's philosophy of long-term investing, where market downturns are welcomed as opportunities for disciplined acquisition, not as triggers for panic. In essence, the introduction serves as a prelude to the deeper exploration of investment principles that prioritize stability, rationality, and long-term value over short-term speculation and market-driven excitement. It promises to arm readers with the knowledge and tools to build a resilient investment foundation, where ambition is tempered with a disciplined and thoughtful approach, a framework that encourages long-term success rather than chasing ephemeral market trends. Moving into Chapter 1, titled Investment versus Speculation, the text clarifies the crucial distinction between investing and speculating, an understanding that is fundamental for any individual investor. This distinction, first articulated by Graham in his 1934 work Security Analysis, remains vital today. Graham defined an investment operation as one that, after thorough analysis, promises the safety of principal and a reasonable return. Any operation that fails to meet these criteria, Graham asserted, is speculative. Despite the vast changes in the financial landscape since the Great Depression, this definition remains as relevant now as it was then. In fact, after the 1929 to 1932 market crash, common stocks were often viewed as speculative investments, requiring a defense of the investment definition to encompass them. Yet today, the term investor is often misapplied, with many market participants, regardless of their methods, lumping themselves under this label, even when engaging in high-risk speculative activities. This misunderstanding, the book cautions, can lead to confusion and potentially harmful financial practices. The chapter emphasizes that speculation involves assuming higher risk in exchange for the possibility of higher returns, often without adequate analysis or consideration for the preservation of capital. In contrast, investing is characterized by a disciplined, methodical approach aimed at safeguarding principal while securing reasonable returns over time. This distinction is essential for anyone hoping to achieve long-term financial success, particularly for those new to the markets or lacking a professional background. The chapter then introduces the defensive investor, who seeks safety and stability while minimizing the effort required to manage their portfolio. For the defensive investor, maintaining a balance between high-quality bonds and leading common stocks is paramount, typically maintaining a 50-50 ratio with adjustments made depending on market conditions. Historically, this strategy has yielded average returns of about 7.5% annually, a figure that, while lower than the broader market's long-term average, is more reliable and sustainable. The book advocates for a balanced, prudent approach to investing, especially during periods of significant market fluctuations. It discusses the changing bond yields and stock returns between 1964 and 1971, noting that in certain conditions, bonds may provide a preferable investment option. Yet, recognizing the unpredictability of markets, it stresses the importance of maintaining a balanced portfolio, with substantial portions in both stocks and bonds to mitigate risks. Several strategies for the defensive investor are then introduced. Investment funds. The book suggests investing in well-established funds or utilizing professional management services from investment firms. These options provide diversification and expertise, helping to manage risk. Dollar cost averaging. This strategy involves consistently investing a fixed amount in stocks at regular intervals, allowing investors to purchase more shares when prices are low and fewer when prices are high. This approach helps smooth out market fluctuations and reduces the impact of short-term volatility. Formula investing. This strategy recommends adjusting stock holdings in response to market movements, maintaining a dynamic but balanced portfolio. By periodically rebalancing the portfolio, the investor stays aligned with their long-term goals while minimizing unnecessary risks. These strategies, along with a fundamental understanding of the difference between investment and speculation, help guide the defensive investor toward achieving stable, satisfactory returns over time. As we transition into the section on the aggressive investor, we find that such an investor seeks to outperform the market, striving for higher returns compared to a more passive, defensive approach. While the pursuit of higher returns is noble, the book emphasizes that the aggressive investor must also understand the inherent risks involved. The primary goal for an enterprising investor should not just be high returns, but the preservation of capital and the avoidance of excessive risks, principles that remain grounded in Graham's teachings. Thus, the journey of both the defensive and the aggressive investor is marked by the same critical qualities: discipline, patience, and a long-term perspective. Only through these qualities can one navigate the complexities of the market successfully, avoiding the pitfalls of speculation and the allure of short-term gains. Continuing from the earlier discussion on the importance of prudent, disciplined investing, we now turn to the broader critique of the strategies that often lead to underperformance. While thorough research and natural skill can be valuable assets, they can also result in losses if misdirected. The critical challenge is not just possessing expertise, but ensuring that it's applied to strategies with realistic potential for success. Understanding this distinction is paramount in avoiding common pitfalls, many of which are seen in widely used investment strategies. Common strategies and their pitfalls. Trading in the market. This strategy involves buying stocks during market upswings and selling them during downturns, often focusing on stocks that are outperforming the market. Some investors also engage in short selling, betting on the decline of certain stocks to profit by buying them back at lower prices. While this may seem attractive, trading is inherently speculative. It doesn't provide the security of principal or the satisfaction of reliable returns, and is often driven by short-term market fluctuations rather than solid, fundamental analysis. Short-term selectivity. This approach involves purchasing stocks of companies that are expected to report favorable earnings or other positive developments in the near future. The challenge here is that anticipated outcomes are often already priced into the stocks, diminishing the potential for above-average returns. Predicting short-term price movements is notoriously difficult and often leads to disappointment when stocks fail to meet inflated expectations. Long-term selectivity. This strategy focuses on companies with a strong growth track record, with expectations that their success will continue. It also includes investing in emerging companies in promising sectors like technology or pharmaceuticals. However, the inherent uncertainty in predicting long-term success means that even if these companies perform well, their potential may already be priced into the stock, leaving little room for exceptional returns. The fundamental challenge with stock selection, whether short-term or long-term, is that predictions can be wrong, and even correct forecasts may not yield higher returns if the market has already factored them in. Wall Street's intense competition and the expertise of professional analysts make it incredibly difficult for individual investors to consistently outperform the market. Sound and unconventional policies for superior results. For an investor to achieve better-than-average results, they must adopt strategies that are inherently sound yet not widely practiced on Wall Street. Speculative movements often lead to mispricing, but identifying and capitalizing on undervalued stocks, especially those overlooked by the market or negatively impacted by unjustified biases, requires patience and resilience. Similarly, short-selling overvalued stocks is not for the faint of heart. It demands not only financial acumen but also considerable courage and financial stability. Special situations. Historically, special situations, such as intersecurity arbitrages, liquidations, and certain hedges, offered investors opportunities for substantial returns with minimal risk. Merger and acquisition deals, in particular, provided profitable avenues for enterprising investors. However, increased competition and other obstacles have diminished these opportunities in recent years. Historical perspectives and changing dynamics. In the past, strategies like buying stocks below intrinsic value or employing the Dow theory were considered reliable and profitable. But as market dynamics evolved and competition intensified, the reliability of these methods has diminished. For example, the once common practice of investing in working capital stocks, which provided steady returns, has become increasingly scarce. This shift underscores the importance of adapting investment strategies to current market conditions. Despite these challenges, opportunities still exist for the enterprising investor. The vast array of marketable securities includes undervalued stocks that can be identified using logical, reliable standards. Achieving satisfactory returns from these investments may require adding approximately 5% annually to the average market return before taxes. But the key is developing effective stock selection approaches that justify the investor's effort and resources. Conclusion: risks and rewards of aggressive investing. While aggressive investing inevitably comes with inherent risks and challenges, a disciplined approach grounded in sound, less conventional strategies can offer the potential for superior returns. But these strategies must be carefully considered, as they come with both rewards and the potential for significant setbacks if mismanaged. Commentary on Chapter 1: Investment versus Speculation. The opening chapter of The Intelligent Investor makes a critical distinction between investing and speculation, something Benjamin Graham, the father of value investing, emphasized throughout his work. True investment, according to Graham, is rooted in thorough analysis, the safety of principle, and the pursuit of adequate returns. In contrast, speculation is defined as betting on price movements without regard to the underlying value of the asset. Graham's definition of investing is stringent and methodical. Thorough analysis. Investors must thoroughly understand a company and its business before purchasing its stock. Safety of principal. Protecting against significant losses is paramount. Adequate returns. Investors should aim for satisfactory returns, not extraordinary performance. Investors, Graham argues, should determine the worth of a stock based on the value of the business it represents, while speculators are only concerned with market price fluctuations. The dangers of speculation. Speculation is often likened to gambling, with the stock market compared to a casino. The allure of quick gains can draw many into speculative trading, but Graham warns that this is a perilous path. Speculators often contribute to their broker's wealth rather than their own, driven by a misinterpretation of market movements and a thirst for short-term profits. Historical context and examples. Graham's insights are supported by historical examples, particularly from the rampant speculation of the 1990s. Investors abandoned patience and prudent analysis for rapid trading and speculative strategies. Notable instances include the Fidelity Mellon Fund, managed by Jeffrey Vinnick, which saw high turnover in technology stocks despite the manager's professed long-term strategy. The online trading boom of the late 1990s further fueled speculative trading, with stocks like Puma Technology and internet companies experiencing wild price swings, detached from their actual business value. Flawed strategies and lessons learned. Several speculative strategies that gained popularity during the late 20th century, such as the January effect and James O'Shaughnessy's method, are critiqued for their lack of sustainability. These strategies, once profitable, failed to deliver long-term results as more investors exploited them, diminishing their effectiveness. Lessons from Graham. Graham's teachings underscore the need for a disciplined approach to investing. He advises against confusing speculation with investment and suggests maintaining a small, separate account for speculative endeavors, limiting it to 10% of one's total portfolio. This approach acknowledges the human tendency toward gambling but confines it within safe bounds. Conclusion. Foundations for long-term wealth. Chapter 1 serves as a foundational lesson in distinguishing between investing and speculation. By adhering to Graham's principles of thorough analysis, risk management, and reasonable expectations, investors can avoid the pitfalls of speculation and build sustainable wealth. The chapter's timeless advice remains relevant, reminding investors to stay grounded in fundamentals and wary of the seductive but dangerous allure of speculation. Chapter 2. The Investor and Inflation. In recent years, inflation has become a significant concern for both the public and Wall Street. The erosion of the dollar's purchasing power, coupled with the fear or hope of further declines, has deeply affected those with fixed dollar incomes or investment principles. This chapter explores the impacts of inflation on investment decisions, helping investors understand how best to mitigate its effects while still achieving growth. Inflation and investment strategies. While stocks offer the potential for higher returns, they are not immune to inflation. Historically, stocks have outpaced inflation, but this doesn't guarantee that they will continue to do so in the future. As inflation rates rise, the real returns on stocks may decrease, particularly if market volatility is high. Bonds, on the other hand, may offer stability but often fail to outpace inflation during periods of high economic pressure. The key takeaway for investors is the importance of diversification. A balanced approach, combining both stocks and bonds, provides a buffer against the uncertainties of inflation and market conditions. For conservative investors, particularly those worried about inflation, adding assets like Treasury inflation-protected securities, TIPS, and real estate investment trusts, REITs, can help hedge against inflation while maintaining a steady income stream. Conclusion. Diversification and resilience. Ultimately, understanding inflation's impact and using strategies like diversification can help investors protect their wealth. By following Graham's timeless principles, investors can navigate the challenges of inflation and market fluctuations while staying on track to meet their financial goals. Continuing from the discussion on disciplined investing and the prudent approach advocated by Graham, Chapter 3 takes a deeper dive into the historical perspective of the stock market, offering crucial insights for investors seeking long-term financial security. In this chapter, titled A Century of Stock Market History, Graham sets the stage for understanding the fluctuations of stock prices, using data to provide a clearer perspective on current market levels and trends. The analysis centers around the market conditions as of early 1972, offering a compelling framework for evaluating stock prices and making informed investment decisions. Overview and historical data. Chapter 3 emphasizes the importance of understanding stock market movements, earnings, and dividends over the course of the last century, starting in 1871. This historical context provides valuable data that helps investors assess the risks and opportunities that arise in different market conditions. While the reliability of this data improved in the latter half of the 20th century, it highlights the significant fluctuations and the steady growth of the stock market through multiple market cycles. Investors are urged to consider these patterns when evaluating whether current market levels are attractive or overextended. Key historical patterns and data presentation. The chapter presents historical data through 2 tables and a chart, illustrating the ebb and flow of the stock market over the past century. Table 31 outlines the high and low points of 19 major bear and bull markets, measured by 2 key indexes: the Standard & Poor's 500 Composite Index and the Dow Jones Industrial Average, DJIA. The accompanying chart, courtesy of Standard & Poor's, visualizes fluctuations of its 425 Industrial Stock Index from 1900 to 1970, revealing 3 distinct periods: 1900 to 1924. This period was characterized by market cycles lasting 3 to 5 years, with an average annual advance of about 3%. 1925 to 1949, marked by the new era bull market that ended in the 1929 crash, followed by irregular fluctuations, with an annual growth rate of just 1.5%. 1950 to 1970, the longest and most significant bull market in history, where the DJIA rose more than 6-fold, despite important setbacks, ultimately culminating in December 1968. Market cycles and investment sentiment. Graham explores the substantial market gains observed from 1949 to 1966, where the DJIA saw incredible growth, but this optimism led to unrealistic expectations of perpetual high returns. As a result, when the market corrected between 1968 and 1970, it revealed the dangers of speculative exuberance. The rapid recovery of the market in earlier years fostered a belief that market gains were guaranteed, which ultimately led to disillusionment when the market faced significant setbacks. This psychological cycle of overconfidence followed by harsh corrections highlights the volatility of speculative markets. Earnings, dividends, and price-earnings ratios. Graham also compares stock prices with corresponding earnings and dividends, using 10-year averages to track long-term growth patterns. Notably, the post-World War II era saw superior performance compared to earlier decades, though the growth rate in the 1960s was notably less than in the 1950s. A significant point of concern was the deterioration of corporate earnings in the 1970s, which were marked by the lowest profit rates since the war and a wave of significant corporate bankruptcies. 1972 Market Evaluation. In evaluating the market as of early 1972, the chapter highlights that stock prices, although lower than during the peaks of 1963 and 1968, were still higher than during the early years of the bull market. The analysis also reveals that while the price-earnings ratio for the market was more favorable compared to certain past years, the adverse change in the bond yield-stock yield ratio rendered the market unattractive for conservative investors. Despite technical indicators favoring potential upward movement, Graham urges caution, particularly given the recent market downturns that suggested caution rather than exuberance. Conclusion and investment recommendations. The chapter concludes by reflecting on the difficulty of predicting market movements, emphasizing that a consistent and disciplined investment strategy should take precedence over attempts to time the market or pick individual winners. Graham advocates for a balanced portfolio, with a maximum of 50% allocated to stocks, and suggests suspending new investments if the market is perceived as dangerous. This approach aligns with the overarching theme of prudence and stability, reinforcing the idea that patient, long-term investing is the key to achieving financial security. Commentary on Chapter 3, Bull Market Baloney. In this chapter, Graham not only critiques past market behavior but also demonstrates remarkable foresight, predicting the severe bear market of 1973 to 1974, during which U.S. stocks plummeted by 37%. He warns of the dangers of extrapolating future market performance solely based on past trends, a practice that gained significant traction in the 1990s as market pundits and popular investment books promised continued high returns. Graham's central thesis is a cautionary tale about the flawed reasoning that emerged in the aftermath of bull markets. The 1990s saw an explosion of overly optimistic projections, as exemplified by books like Stocks for the Long Run by Jeremy Siegel, and more extreme predictions such as the infamous Dow 36,000. These projections, fueled by the euphoria of the dot-com bubble, ignored the fundamental principles that Graham had long championed. His warnings about extrapolating past successes into the future ring even truer today, reminding investors of the importance of cautious, thoughtful analysis rather than blind optimism. The perils of extrapolation. Graham cautioned against using past performance as a blueprint for future returns. The allure of extrapolating from previous bull markets, especially during periods of rapid growth, can create unrealistic expectations and breed complacency. The 1990s, a decade marked by significant market exuberance, became a prime example of this issue. Investors, lured by promises of perpetual growth, failed to adequately assess the underlying risks and were caught off guard by the market's sharp corrections. Graham's critique also extends to the idea of buy and hold as a foolproof strategy. While this approach can work in a broad, market-wide sense, it can be dangerous if investors fail to account for the fluctuations and cycles that characterize financial markets. Just because stocks have historically increased in value doesn't mean they will continue to do so without significant risk. Conclusion. Chapter 3 serves as both a historical analysis and a warning for modern investors. Graham's reflections on the cyclical nature of the market, the dangers of extrapolation, and the importance of long-term, prudent investment strategies offer timeless advice. As we move forward in our journey through The Intelligent Investor, it's clear that understanding market history, maintaining a disciplined approach, and avoiding speculative excesses are essential to achieving long-term financial success. This chapter, like the ones before it, underscores the value of patience and sound judgment, reminding us that the road to financial security is paved not with market predictions or speculative bets, but with careful, informed decision-making grounded in historical insight and prudent risk management. Building on Graham's wisdom of disciplined, long-term investing, Chapter 3 sets the stage for understanding the intricate dynamics of stock market history. It reinforces the idea that an investor's best defense against market turbulence is the cultivation of patience and realistic expectations. As we transition into the subsequent analysis, we shift our focus to how investors, particularly those with a defensive mindset, can construct a sound portfolio strategy that stands the test of time. Graham's principles are timeless, advocating for a balanced, pragmatic approach to portfolio management, grounded in the realities of both market cycles and individual circumstances. Chapter 4. General Portfolio Policy for the Defensive Investor. In this pivotal chapter, Graham dives deeper into the core characteristics of a defensive investor's portfolio. His approach emphasizes strategic asset allocation, highlighting that the structure of an investment portfolio should align with the investor's financial goals, risk tolerance, and personal preferences. This is the heart of creating long-term financial security, the recognition that there is no one-size-fits-all solution. Historically, institutions like savings banks, life insurance companies, and legal trust funds were constrained by legal mandates to limit their investments to high-grade bonds and preferred stocks. These were seen as the safe and steady route. In contrast, affluent individual investors, armed with the ability to bear more risk, could afford to diversify into a broader array of stocks and bonds, chosen not out of necessity but for their attractiveness based on fundamental analysis. The contrast here is striking. On one side, the cautious institutional investor, seeking stability, and on the other, the experienced individual investor, prepared to take calculated risks for potentially greater returns. The return-risk relationship, paradigm shift. A long-standing investment principle suggests that the return on investment is directly correlated with the level of risk an investor is prepared to accept. Historically, this correlation has been true, but Graham introduces a subtle shift in perspective. Returns should not only correlate with risk, but with the intelligent effort an investor is willing to commit. This notion challenges the traditional belief that simply increasing risk guarantees higher returns. Instead, those who invest passively and seek minimal engagement should expect lower returns, while active, knowledgeable investors, by selecting well-priced bargains, could achieve higher returns, often with lower risk than standard high-grade bonds. Bond and stock allocation for the defensive investor. For the defensive investor, Graham advocates a balanced portfolio, one that maintains a careful mix of high-grade bonds and common stocks. A cornerstone of Graham's portfolio strategy is that no more than 75% of the portfolio should be in stocks, and no less than 25% in high-grade bonds. A typical recommendation is a 50-50 split between stocks and bonds. However, Graham's approach is dynamic, recommending that this ratio be adjusted based on market conditions. During times when stocks are undervalued, such as in bear markets, increasing the stock portion is advised. Conversely, when stocks are overvalued, decreasing the stock portion and allocating more to bonds helps shield the investor from market volatility. This disciplined approach might seem simple, but it requires a level of emotional resilience to execute properly. Humans have an innate tendency to chase market extremes, buying when prices are high and selling when they are low. To counteract these tendencies, Graham suggests a simple yet effective 50-50 allocation rule. For instance, if the stock portion of the portfolio rises to 55%, the investor should rebalance by selling some stocks and purchasing bonds, and vice versa if stocks drop to 45%. This method, though straightforward, offers a safeguard against excessive market exposure, making it easier for the defensive investor to weather fluctuations without being swayed by the prevailing market sentiment. Historical applications and challenges. Institutions like Yale University have historically employed similar strategies, though they often struggled to maintain this balance during periods of significant market advances. These institutional challenges only reinforce the importance of sticking to the principles of diversification and prudent rebalancing, regardless of the temptation to chase returns. The bond component, a critical decision. When selecting bonds, investors face two major questions. Should they choose taxable or tax-free bonds? And what maturity length is ideal for their needs? These decisions are often influenced by the investor's tax situation and need for liquidity. In the early 1970s, for instance, high-income investors preferred tax-free municipal bonds due to the advantageous after-tax yield. Long-term versus short-term bonds. Graham highlights the distinction between long-term and short-term bonds. Long-term bonds generally offer higher yields but come with the risk of price declines if interest rates rise. Short-term bonds, on the other hand, provide greater price stability but yield less. Each type carries its own benefits, and the choice depends on the investor's preference for stability versus yield. For those with modest capital, U.S. savings bonds are an attractive choice due to their safety, tax advantages, and flexibility, despite their lower yields. Risk considerations and high-yield bonds. Graham also touches on the allure of higher-yielding, lower-grade bonds. While these can offer better returns, they carry substantial risks that make them unsuitable for defensive investors. A more prudent alternative to these riskier bonds is high-yield savings deposits in banks, which offer competitive rates without the accompanying risks of bonds. Convertible issues and preferred stocks. Although convertible bonds and preferred stocks can offer higher returns, they are more complex and less reliable for defensive investors. Their variability and potential instability make them less desirable compared to bonds, which offer a more predictable income stream. Preferred stocks, in particular, are tied closely to the issuing company's performance, making them a risky option for those seeking stability. Conclusion. the defensive investor's balanced approach. Graham's final recommendation is a balanced, diversified portfolio with a disciplined approach to stock and bond allocation. By periodically rebalancing, maintaining a 50-50 stock-to-bond ratio, and adjusting as needed, defensive investors can achieve reasonable returns while managing risk effectively. The simplicity of this approach, combined with its inherent prudence, forms the cornerstone of a robust defensive investment strategy. Chapter 4. The Investor's Personality and Risk Tolerance. Graham's investment philosophy, while rooted in sound financial principles, also recognizes the critical role of personality and temperament in shaping investment strategies. As the chapter opens with a quote from Pat Riley, "Risk is an inevitable part of investing, and the risk of leaving investments to chance can be greater than the risk of the investment itself." The chapter emphasizes the need for an investor to understand their own risk tolerance and adapt to their strategy accordingly. Graham distinguishes between two primary types of investors: the active or enterprising investor and the passive or defensive investor. Active investing requires continuous research and monitoring of diverse assets, demanding a high level of intellectual effort and time commitment. In contrast, passive investing is more about constructing a stable portfolio that requires minimal intervention, providing less excitement but often offering more reliable, long-term returns. Graham encourages investors to assess their own financial needs and psychological readiness for risk before choosing a strategy. Active investors with the time, resources, and intellectual engagement may find fulfillment in stock picking and active management. On the other hand, those who value simplicity and prefer to avoid the emotional strain of managing their investments may lean towards a more passive, defensive approach. Conclusion: adapting strategy to personality and lifestyle. Graham advises against the conventional rule that one should adjust their investment portfolio based solely on age. Instead, he advocates for a more personalized approach, one that considers both financial circumstances and future needs. This nuanced perspective challenges the traditional subtract from 100 rule, suggesting that life events, income security, and personal goals should guide one's asset allocation strategy. Whether through active or passive investing, the key is to remain disciplined and self-aware, making informed choices that align with both financial goals and personal preferences. This chapter reinforces the importance of understanding one's financial situation and psychological profile when making investment decisions. By choosing a strategy that aligns with these factors, investors can better navigate the complexities of the market while minimizing emotional stress and optimizing returns over the long run. Continuing from the broader themes of disciplined, long-term investing, Chapter 4 in The Intelligent Investor delves into practical strategies for defensive investors who are navigating volatile markets. As we explore asset allocation, Graham emphasizes the necessity of a diversified portfolio to mitigate risks and ensure stability. Many investors, particularly during market downturns, find it difficult to maintain their commitment to stocks when faced with significant losses. This often leads to poor decision-making, such as selling stocks at the lowest point. By ensuring a minimum of 25% in bonds, Graham provides a cushion that helps investors stay the course, particularly when stock markets are underperforming. Asset allocation, tailoring to personal circumstances. As the chapter unfolds, Graham underscores the importance of customizing asset allocation based on personal circumstances. Factors such as marital status, career risks, children, and future financial needs should guide investment choices. He stresses the value of a disciplined rebalancing strategy to maintain target allocations. Semi-annual adjustments are recommended to prevent emotional reactions to market fluctuations, ensuring that investors don't let fear or greed dictate their decisions. The chapter also touches on the idea of a 100% stock portfolio, deeming it suitable only for a small subset of investors. These are individuals who have a long-term investment horizon and the emotional fortitude to withstand bear markets without panicking. This reinforces the central message of maintaining a diversified portfolio to mitigate risks and ensure stability over time. Diversification is, therefore, the bedrock of stability in a world where market dynamics are ever-changing. Income Investing, a Modern Perspective. Moving beyond Graham's original advice, the chapter introduces modern investment tools and options. It discusses the relative merits of taxable versus tax-free bonds, the trade-offs between short-term and long-term bonds, and the advantages of bond funds over individual bonds. Furthermore, it explores alternative investment options, such as mortgage securities, annuities, preferred stocks, and common stocks with high dividend yields. By expanding the toolbox of available investment vehicles, Graham's insights remain highly relevant to today's investor, ensuring that readers are equipped to make informed decisions based on their unique financial goals and risk profiles. Chapter 5. The Defensive Investor and Common Stocks. The next chapter dives into the role of common stocks in a defensive investor's portfolio. Historically, common stocks were viewed with skepticism, particularly in the years following the market decline of 1946. During this period, stocks were considered speculative and unsafe. However, over the next 2 decades, stock prices surged, leading many to perceive stocks as relatively safe and profitable investments, albeit at historically high levels. The case for common stocks. Graham's argument for including common stocks in a portfolio hinges on 2 key points. Inflation protection. Unlike bonds, which provide no hedge against inflation, common stocks have historically served as a substantial defense against inflation. As the purchasing power of money erodes, stocks, with their potential for dividend growth and capital appreciation, offer investors a tangible way to protect their wealth. Higher returns. Historically, stocks have delivered higher average returns compared to bonds, driven by both high dividend yields and the underlying growth in market value as companies reinvest their profits into expansion. However, Graham consistently warns that these benefits can be nullified if stocks are purchased at excessively high prices. He points to the market crash of 1929 as a stark reminder that overpaying for stocks can lead to decades of stagnation. Despite this, Graham maintains that defensive investors should still hold a significant proportion of common stocks in their portfolios, as they represent a less risky alternative to an all-bond portfolio. Rules for selecting common stocks. When it comes to selecting common stocks, Graham outlines 4 key rules. Adequate diversification. Hold between 10 and 30 different stocks to reduce company-specific risk. Large, prominent, and conservatively financed companies. Focus on well-established firms with a solid financial foundation. A long record of continuous dividends. Companies should have a history of uninterrupted dividend payments, ideally since at least 1950. Price limitations. Avoid paying more than 25 times the average earnings of the past 7 years or 20 times the earnings of the last 12 months. This rule helps protect against purchasing overpriced growth stocks, which, while appealing, carry significant risk. Growth stocks. The risk of overpaying. While growth stocks can offer rapid earnings growth and high future potential, they often come with sky-high valuations. The speculative element inherent in these stocks adds considerable risk. Graham warns that even leading growth stocks, such as IBM and Texas Instruments, can experience severe price drops. Therefore, defensive investors should avoid growth stocks due to their inherent uncertainty and volatility. Practical portfolio adjustments. Investment portfolios should be regularly reviewed to maintain or improve their quality. Graham advises that defensive investors seek advice from investment counselors or brokerage houses, but emphasizes that they should stick to the basic rules of stock selection. Frequent changes are unnecessary if the initial selection was sound. One proven strategy for the defensive investor is dollar-cost averaging. By investing a fixed amount in stocks at regular intervals, regardless of market conditions, investors can reduce the impact of market volatility. Graham cites Lucille Tomlinson's study, which demonstrates that this approach has yielded positive results over time, even during the Great Depression. Investment based on personal situation. Graham also highlights that investment choices should align with the investor's unique circumstances. He illustrates this with 3 distinct scenarios. A widow with $200,000. She needs to balance income generation with conservatism, possibly splitting her portfolio between bonds and stocks. a doctor with $100,000 savings. This investor has more flexibility and can consider enterprising investments, but should still prioritize safety. A young man earning $200 per week. He should follow the defensive investor's approach, saving in Series E bonds and diversifying his stock portfolio. This personal approach reinforces the idea that one-size-fits-all investment strategies rarely work in the real world. Instead, individual goals and financial circumstances should dictate the investor's asset allocation. The concept of risk. Finally, Graham clarifies the concept of risk. Many investors equate risk with price fluctuations, but true risk, according to Graham, is the permanent loss of value. Price volatility alone is not risk if the investor does not sell during downturns. When properly selected, common stocks, despite their price fluctuations, can provide satisfactory returns over time without substantial risk of permanent loss. Commentary on Chapter 5, A Strategic Approach to Defensive Investing. Benjamin Franklin's observation that happiness is derived from small daily advantages rather than rare significant fortunes perfectly encapsulates the ethos of defensive investing. In Chapter 5, Graham reinforces this principle, emphasizing that consistent, informed, and strategic actions in investing can yield long-term financial stability. This approach does not require chasing the highs of speculative markets, but rather steady, thoughtful progress that builds wealth over time. Reevaluating defensive strategies. The chapter also addresses the skepticism many investors feel toward stocks after significant market losses, such as those experienced in the early 2000s. While such crashes may leave investors wary of stocks, Graham argues that market downturns can actually reduce risk by bringing stock prices to more reasonable levels. This counterintuitive perspective encourages investors to avoid letting past losses cloud their judgment, especially when stocks are priced to offer future growth potential. Embracing stock investment with ease. With modern tools like index funds and automated investment plans, investing has become far more accessible. Graham encourages defensive investors to take advantage of these tools, which simplify the process and ensure disciplined investing. By focusing on long-term stability rather than short-term gains, investors can navigate market fluctuations with confidence and achieve steady growth. Conclusion: embracing stability with confidence. Ultimately, Chapter 5 emphasizes the importance of a diversified, disciplined approach to investing. By embracing the uncertainty of financial markets with a strategy that balances risk and effort, defensive investors can achieve steady growth while avoiding the emotional and speculative pitfalls that derail many others. This approach allows investors to stay focused on the long term, avoiding the distractions of fleeting market trends, and ensures that they can weather the inevitable fluctuations with a steady hand. Continuing from the foundational principles of prudent investing, Chapter 7 of The Intelligent Investor delves deeper into the complexities of market timing, growth stock investing, and the critical importance of diversification. Graham, ever the pragmatist, cautions against the seductive allure of speculative strategies that often lead to devastating losses. While aggressive investors may opportunistically capitalize on undervalued assets, particularly during market downturns, the defensive investor is urged to remain cautious and avoid such high-risk endeavors. This distinction highlights the importance of discernment when constructing a portfolio, as not all assets or strategies align with an investor's risk tolerance or objectives. The perils of market timing and growth stocks. Market timing, often romanticized as the key to maximizing returns, is an endeavor that remains elusive for the majority of investors. Graham, through poignant anecdotes and historical insights, debunks the myth of reliably predicting market movements. The pursuit of market timing, he argues, is more an exercise in hindsight than foresight, offering no real advantage to those who try to outguess the market. Figures like Alan Greenspan and Kate Lee exemplify how even the most seasoned experts struggle to consistently forecast market shifts. The message here is clear. Market timing is a futile pursuit for most, leading only to unnecessary anxiety and poor decision-making. As we transition into growth stock investing, the narrative shifts to the attractive yet dangerous appeal of rapid company expansion. Graham meticulously dissects iconic growth companies like General Electric, Home Depot, and Sun Microsystems, demonstrating how the high growth trajectory of these companies often leads to inflated stock prices. The inverse relationship between growth and affordability becomes apparent. Just because a company is growing rapidly does not mean it is a great investment if purchased at an exorbitant price. This insight echoes Graham's timeless adage: a great company does not necessarily make a great investment. The risks of overconcentration. Moving further into the investment landscape, Graham warns against the perilous risks of overconcentration. While concentrated positions in a single asset or sector may seem attractive in times of high optimism, history has repeatedly shown that such a strategy can lead to catastrophic losses. Drawing on historical precedents, Graham emphasizes the importance of diversification as a fundamental safeguard against unforeseen market upheavals. The sharp contrast between diversified and concentrated fortunes, as seen in the trajectories of different investors, underscores the essential role diversification plays in mitigating risk. This discussion on concentration leads to a deeper examination of international diversification. Graham, ever mindful of the global economy's interconnected nature, urges investors to broaden their horizons beyond domestic markets. The cautionary tale of Japanese investors during the 1980s serves as a stark reminder of the risks associated with home bias, investing primarily in one's own country's stocks. By embracing international markets, investors can hedge against domestic economic volatility, thus enhancing the stability of their portfolios. Market timing and speculation. The role of Mr. Market. The narrative continues by delving into the psychology of market behavior, personified by Graham's famous metaphor of Mr. Market. In this metaphor, Mr. Market is portrayed as a manic-depressive entity whose valuation of stocks swings wildly between irrational exuberance and unjustified pessimism. Investors, Graham argues, should not be swayed by Mr. Market's erratic mood swings but instead focus on the intrinsic value of stocks. By learning to harness Mr. Market's volatility, investors can buy undervalued stocks during market lows and exercise caution during market highs. The story of Intimi Corp in the early 2000s serves as a cautionary case study. Despite chronic unprofitability, Intimi Corp was valued at $25 billion due to Mr. Market's irrational exuberance. The subsequent crash, where its stock plummeted, highlights the dangers of investing based on market sentiment rather than company fundamentals. Graham's emphasis on independent thinking is reinforced here. Investors must resist the herd mentality that often drives speculative decisions and instead focus on the long-term value of the businesses they invest in. The human element in investing. At the heart of this chapter is an exploration of the psychological challenges investors face when navigating market fluctuations. Human nature is wired to seek patterns and react emotionally to gains and losses, which can lead to irrational behavior, such as chasing rising stocks or panic selling during downturns. By recognizing these tendencies, investors can implement strategies like dollar-cost averaging, which helps mitigate the impact of market volatility. This approach ensures that investors continue to contribute to their portfolios regularly, without trying to time the market or make decisions based on short-term market movements. The importance of discipline and patience. Graham's teachings consistently emphasize the need for patience and discipline in investing. In times of market downturns, rather than succumbing to fear, investors should view falling prices as buying opportunities. This mindset allows them to benefit from market cycles, aligning perfectly with Graham's long-term investment philosophy. By focusing on intrinsic value, investors can avoid the pitfalls of speculative trading and capitalize on market mispricings. The chapter also introduces the concept of tax loss harvesting during bear markets, selling losing stocks to offset gains and reduce taxable income. This strategy not only helps manage tax liabilities but also provides an opportunity to reinvest in the same or similar stocks at lower prices, effectively benefiting from Mr. Market's irrational swings. Commitment to long-term investment strategies. To solidify a disciplined investment approach, Graham suggests that investors use an investment owner's contract to commit to regular long-term investing. This contract serves as a commitment to sticking to a long-term financial plan, resisting the temptation to react impulsively to market volatility. By doing so, investors can avoid making emotionally charged decisions that could undermine their financial goals. Conclusion: embracing the uncertainty of financial markets. In summary, Chapter 8 of The Intelligent Investor provides a comprehensive framework for understanding market psychology, the dangers of herd behavior, and strategies for maintaining an independent, disciplined investment approach. By learning from historical market episodes and applying principles from behavioral finance, investors can better navigate the complexities of Mr. Market's moods and achieve their long-term financial goals. This chapter reinforces the critical lesson that, in investing, success lies not in predicting market movements or chasing short-term trends, but in embracing the uncertainty of financial markets with a strategy rooted in value investing, patience, and discipline. By staying focused on long-term goals and maintaining a diversified, disciplined portfolio, investors can achieve financial success while mitigating the emotional and speculative pitfalls that often derail others. Now, as we move forward to Chapter 9, we will examine mutual fund investing, a key strategy for defensive investors looking to enhance their portfolios with professional management and diversified holdings, providing a practical approach to investing for those seeking simplicity and stability. Following the prudent guidelines laid out in the earlier chapters, Chapter 7 of The Intelligent Investor continues to deepen our understanding of the delicate balance between speculative risk and informed, value-based investing. Graham emphasizes the importance of knowing when to engage with volatile assets, such as foreign bonds or secondary common stocks, which may be suitable for more aggressive investors but are often too risky for the defensive investor. This distinction between defensive and aggressive investors is central to maintaining a well-constructed, risk-adjusted portfolio. The essence of security analysis. A pragmatic approach. The heart of sound investment lies in meticulous analysis. To this end, the chapter explores the role of security analysts, whose job is to investigate the past, present, and future of securities. This involves a comprehensive assessment of a company's business model, its financial health, and its potential for future earnings. The analyst must identify the strengths and weaknesses of a company, assess its risks and opportunities, and gauge its market attractiveness. With these analyses, investors can make informed decisions about whether bonds are safe or stocks are worth the price. Techniques and standards in security analysis. Security analysts employ a wide range of techniques, from simple to complex, to evaluate a company's financial health. One of the most reliable areas of security analysis is bond safety, which is largely determined by a company's ability to cover interest payments with past earnings. For preferred stocks, the safety measure includes coverage of both interest and dividend obligations. Key safety measures include examining earnings coverage, asset values, and equity ratios. Analysts also take into account a company's capital structure, evaluating whether it has too much debt or whether its working capital and assets support future growth. Assessing bonds and preferred stocks. Bonds issued by public utilities, which are subject to regulatory oversight, have historically shown remarkable financial stability. In contrast, industrial bonds, though growing in number, exhibit more volatility, particularly during economic downturns. This distinction underscores the importance of investing in companies with sound capitalization, those that are financially robust enough to weather market fluctuations. On the other hand, common stocks, especially growth stocks, pose a more nuanced challenge. These stocks are often valued based on future earnings projections, which can be fraught with uncertainty. Growth stocks, though promising, carry the risk of overvaluation, where the expectation of future success leads to price inflation. Valuation of common stocks. A delicate balance. Valuing common stocks traditionally involved assessing past performance, but more recently, growth stock investing has taken center stage, driven by sophisticated mathematical models that forecast future earnings and price potential. Despite the sophistication of these models, the projections remain inherently uncertain. Forecasts tend to be more reliable when based on industry-wide data rather than individual companies. further justifying diversification to mitigate risk. To determine a stock's value, analysts apply a formula that involves forecasting future earnings, projecting market value, and calculating an appropriate capitalization factor. Yet, as Graham warns, the past is not always a reliable predictor of the future. A company's past growth trajectory may not align with its future performance, as evidenced by the volatility in high-growth stocks during periods of market speculation. The importance of diversification, the psychological element of investing, cannot be ignored. Many investors tend to become overly attached to a stock or sector, leading them to make decisions based on emotional impulses rather than rational analysis. As Graham would argue, diversification remains the best safeguard against such risks. A well-diversified portfolio, spread across various industries and asset types, provides stability during periods of market upheaval. This principle is especially critical for defensive investors, who prioritize risk management and steady, reliable returns over speculative gains. Investment strategy. Learning from history. The chapter further explores how historical analysis plays a pivotal role in evaluating stock and bond values. By studying market cycles, analysts can uncover patterns that may signal undervaluation or overvaluation. The distinction between defensive and enterprising investors becomes clearer as we consider the strategic use of market fluctuations to buy undervalued stocks during market dips and sell overvalued ones during rallies. However, market timing, though tempting, is fraught with challenges. The reality of trying to predict market movements with precision often leads to disastrous results for individual investors. The perils of overconcentration and market timing. Overconcentration of investments in a single asset, sector, or company can lead to severe consequences, especially when market conditions shift unexpectedly. History is rife with examples of concentrated fortunes collapsing when the market sentiment turned sour, underscoring the critical need for diversification. Similarly, market timing, while an alluring prospect, is shown to be largely ineffective. The success of any investment strategy lies not in predicting the next big market move, but in creating a balanced portfolio that can weather inevitable market fluctuations. The role of international diversification. Graham also underscores the importance of expanding one's portfolio beyond domestic boundaries. In an increasingly globalized economy, international diversification becomes a vital strategy to shield investments from the volatility of any single market. As the cautionary tale of Japanese investors during the 1980s demonstrated, home bias, investing only in one's domestic market, can lead to significant risks in an interconnected world. Conclusion. A pragmatic and long-term approach. Chapter 7 ultimately serves as a call to investors to embrace the fundamentals of value investing while remaining wary of speculative strategies that promise quick rewards but often lead to long-term disappointment. Through detailed analysis, Graham helps investors discern between prudent strategies that lead to sustained growth and high-risk tactics that jeopardize long-term financial stability. By emphasizing the importance of diversification, avoiding overconcentration, and recognizing the limitations of market timing, investors can navigate the complexities of the financial world with greater confidence. The lessons of past market cycles, coupled with Graham's emphasis on a balanced, long-term approach, provide a timeless guide for building a resilient portfolio that can withstand the ebbs and flows of the market. In the next chapter, we will explore the intricacies of common stock analysis, where we will apply these principles to assess a company's intrinsic value, evaluating both the historical and future potential of its earnings and overall market position. As we continue our journey through The Intelligent Investor, we will see how these analytical frameworks come together to form a comprehensive and cohesive investment strategy. In Chapter 15, we transition from the disciplined strategies of defensive investors to the more proactive, sometimes riskier methods employed by the enterprising investor. Building on the foundational wisdom of Benjamin Graham, this chapter offers a comprehensive roadmap for selecting stocks that could outperform the general market, though it acknowledges the challenges inherent in such an endeavor. The challenge of successful stock selection. As the chapter begins, Graham reiterates the daunting task of consistently selecting stocks that can surpass market averages. While mimicking the performance of broad market indices like the Dow Jones Industrial Average, DJIA, may yield average results. Achieving superior returns demands a combination of skill, knowledge, and luck. Despite advances in financial tools and resources, many funds still fail to outperform the market, suggesting that beating the market consistently is no small feat. Two primary explanations are offered for this difficulty. Market efficiency. The concept of market efficiency asserts that stock prices reflect all publicly available information. Therefore, predicting stock price movements, especially in an efficient market, becomes nearly impossible. Flawed analyst approaches. Many analysts focus too heavily on growth prospects and company management, often neglecting the price at which a stock is purchased. This emphasis on continuous growth while appealing rarely materializes in the long run. In reality, most companies experience cycles of growth and decline, and high initial valuations rarely justify their future performance. Unconventional strategies for the enterprising investor. For the enterprising investor, those willing to assume more risk and engage with complex strategies, success lies in identifying undervalued stocks. The strategies outlined for such investors include arbitrage. This involves buying a security while simultaneously selling another security that is set to be converted in a corporate reorganization or merger. The goal is to profit from price discrepancies. Liquidations. Investors may target companies in liquidation, where shares will receive cash payments during the liquidation process. This is often a safer bet compared to stocks of companies that have not yet undergone such processes. Convertible bonds and preferred shares. These securities can be bought, while short-selling the common stock that they will eventually convert into, thereby profiting from the price differences. Net current asset bargain issues, a method where stocks are purchased below their net current asset values, ensuring a margin of safety. These strategies, while highly effective in certain contexts, require significant expertise and a keen understanding of market dynamics. As Graham wisely notes, such approaches are best suited for investors who are not only experienced but also patient and willing to navigate the complexities of the market. Selecting secondary companies, a hidden opportunity. Another promising strategy for enterprising investors is selecting secondary companies, those that are financially sound but underappreciated by the market. Often overlooked, these companies can present opportunities for investors to acquire stocks at a significant discount. Tools like the Standard & Poor's Stock Guide can help identify these undervalued stocks by using criteria such as a low price-to-earnings (P/E) ratio, a strong financial condition, minimal debt and consistent earnings growth, a dividend record that reflects a company's stability. These stocks, while not flashy or high growth, often represent undervalued opportunities that have the potential to provide solid returns over time. Market speculation and special situations. The chapter takes a critical look at the speculative nature of the stock market, particularly during periods of economic exuberance. The late 1990s, for example, witnessed a surge of low-quality stock offerings that quickly attracted enthusiastic buyers, driving their prices to irrational heights. These speculative frenzies often end in sharp market corrections, leaving investors disillusioned. However, bargain issues, stocks priced below their intrinsic value, still provide potential for substantial returns without the excessive risk typically associated with speculative investments. Case studies in special situations. Graham highlights several real-world special situations, corporate events like mergers, acquisitions, or liquidations that have historically yielded impressive returns for astute investors. For instance, the acquisition of Kaiser Roth by Borden Inc. presented an arbitrage opportunity that could have netted investors a 24% return within 6 months. Similarly, the acquisition of Aurora Plastics by National Biscuit Company promised a 25% return. However, as Graham cautions, such opportunities are fraught with risks. The failure of some deals, like Kaiser Roth, which was rejected by its directors, underscores the unpredictable nature of special situations. Despite the potential for substantial profits, These investments require expert judgment to navigate the complexities of corporate actions and the timing of market fluctuations. Ralph Waldo Emerson's insight, the wisdom of independent thinking. The chapter closes with an insight from Ralph Waldo Emerson, whose famous quote about the rarity of individual thought underscores the importance of independent decision-making in investing. Just as Emerson advised that the value of independent thought often surpasses collective opinion, Graham's principles encourage investors to think independently, especially when navigating the speculative tides of the market. Graham emphasizes that while professional money managers may have valuable expertise, the individual investor has the freedom to remain detached from short-term market sentiment and speculation. By adhering to the principles of value investing, focused on intrinsic company value rather than market trends, investors can rise above the noise and volatility, investing with discipline and patience. Conclusion: balancing risk and reward. Chapter 15 concludes with a clear-eyed view of the challenges and rewards of stock picking. While it's true that achieving superior returns requires a mix of skill, strategy, and sometimes luck, Graham's principles offer a clear path for those willing to take on the challenge. By employing unconventional methods, rigorously vetting stocks, and focusing on long-term value rather than short-term trends, enterprising investors can find opportunities that others overlook. For the majority of investors, however, the lesson remains. Diversification, whether through index funds or a diversified stock portfolio, remains the most reliable way to capture substantial market gains while managing risk. Through historical analysis and disciplined decision-making, investors can successfully navigate the complexities of the market and achieve their long-term financial goals. As we proceed to Chapter 16, we will explore special situations in greater detail, examining how these corporate actions can be used strategically to identify value and unlock potential returns, offering a glimpse into more advanced methods of stock selection. In Chapter 15, we shift from the foundational principles of defensive investing to explore the more dynamic and opportunistic world of stock picking for enterprising investors. With Benjamin Graham's insights at the heart of this journey, the chapter outlines how investors with the requisite skill and determination can selectively outperform market averages, despite the inherent difficulties and risks. The challenge of stock picking. At the outset, Graham acknowledges that consistently identifying stocks that will beat the market is not only difficult but also rare. While mimicking market indices such as the DJIA can lead to average returns, exceptional gains require a combination of sharp insight and luck. Even with all the modern financial tools available, many professional investors still struggle to outperform the market consistently. This leads to the heart of Graham's argument, the importance of going beyond conventional wisdom. Two key reasons are identified for why superior stock picking is so challenging. Market efficiency. Stock prices are often seen as reflecting all publicly available information, making it exceedingly hard to predict stock movements, especially since unforeseen developments drive price changes. Flawed analyst approaches. Many analysts focus excessively on growth sectors and managerial competence while ignoring the price at which stocks are bought. This often leads to poor long-term investment outcomes, as growth expectations don't always meet reality. Strategies for enterprising investors. For the enterprising investor willing to take on more risk, Graham outlines several unconventional methods for profiting from market undervaluations. Arbitrage. Buying one security while simultaneously selling another that is set to be converted in a corporate reorganization or merger. Profits come from price discrepancies. Liquidations. Buying stocks of companies undergoing liquidation processes, where investors may receive cash payouts from the liquidation of assets. Convertible bonds and preferred shares. These are purchased with the expectation of price discrepancies between the convertible securities and their common stock counterparts. Net current asset bargain issues. Acquiring stocks priced below their net current asset value, ensuring a margin of safety in the investment. These strategies, though promising, require in-depth expertise and patience, underscoring that such approaches are best suited for investors who are comfortable with complexity and willing to actively manage their portfolios. Secondary companies and hidden opportunities. Another method for enterprising investors involves focusing on secondary companies. those that are financially solid but underappreciated by the market. While overlooked by mainstream investors, these companies often present significant opportunities to acquire undervalued stocks. Using resources like the Standard & Poor's Stock Guide, investors can identify these gems by applying certain criteria such as low price-to-earnings ratios, strong financial conditions, and consistent earnings growth. While these secondary companies may not receive the same market attention as high-growth stocks, they can offer attractive investment opportunities at lower prices, making them ideal candidates for those seeking long-term stability and returns. Speculation and special situations. As Graham cautions, much of the excitement in the stock market is driven by speculative behavior. The late 1990s saw an influx of low-quality stocks driven by euphoria, with prices inflated far beyond what was justified by the underlying financial realities. However, bargain issues, stocks that are priced below their intrinsic value, remain an important part of an investor's toolkit. These investments, if selected carefully, offer the potential for solid returns without the speculative risks associated with boom and bust cycles. The chapter further delves into special situations, corporate events like mergers, acquisitions, and liquidations that offer unique investment opportunities. Graham highlights several cases, such as Kaiser Roth's acquisition by Borden Incorporated, which presented an arbitrage opportunity with potential for high returns. However, as Graham reminds us, these situations are not without risk, and careful analysis is required to differentiate between solid opportunities and those fraught with uncertainty. Embracing independent thought. Lessons from Emerson. The wisdom of Ralph Waldo Emerson underscores the chapter's key message: the importance of independent thinking. Just as Emerson believed in the power of individual thought amidst collective opinion, Graham advocates for a similar mindset in investing. Investors must not be swayed by the transient whims of the market, but rather should focus on the intrinsic value of stocks, making decisions grounded in analysis and reason, not emotion or speculation. By taking an independent approach and adhering to fundamental principles of value investing, investors can rise above the volatility and unpredictability of the market. This mindset allows them to avoid being swept up in speculative booms, such as those seen during the dot-com bubble, and focus instead on the long-term potential of solid investments. Conclusion: a disciplined approach to stock picking. In summary, Chapter 15 provides a nuanced look at the enterprising investor's approach to stock picking. While recognizing the challenges of consistently selecting stocks that outperform the market, Graham offers a set of strategies that, when executed with discipline and skill, can lead to superior results. The key to success in this realm lies not in chasing trends, but in maintaining a balanced approach, informed by fundamental analysis, and always guided by a clear understanding of risk. The chapter concludes by reaffirming the timeless wisdom of Benjamin Graham. Investing is a marathon, not a sprint. The road to superior returns is paved not with shortcuts or speculative leaps, but with careful, calculated steps that prioritize value over speculation. As we turn to Chapter 16, we will explore convertible issues and warrants, examining their potential as investment vehicles, the risks involved, and the strategic considerations for investors looking to leverage these complex instruments in a disciplined way. Thanks for tuning in to MindMirror Audiobook. If this video sparked your curiosity, be sure to like, comment, and subscribe. We've got more thrilling, in-depth content coming your way to help you master the art of investing. Stay with us and discover what's next in your financial journey.